Hey guys, welcome to Learning Accounting. I'm Jim Abdulkabir, the founder of Learning Accounting, and this particular channel is expected to treat all related accounting issues, especially for professional accountants. So we'll be looking at courses like financial reporting, corporate reporting, or strategic business reporting for all type of exams, be it the ACCA exams or the ICANN exams or other related tertiary education exams like the masters, the postgraduate or the undergraduate issues, all those exams, we'll be looking into them. Now I would like you to watch the video and drop any questions in the comment section, and I'll be here to answer your question for you. So stay tuned and watch the video to the end. Hey guys, welcome to Learning Accounting, and today we want to discuss on basic accounting. Now, for those who are just joining the field of accountancy, I think this is an area you want to pay interest in. And also, from experience, I found out that a lot of accountants out there find it difficult to understand double entry principles, and at the same time how to move from source documents down to the final account, which is actually some basic things, but it's also an area of challenge for a lot of people. But I keep saying area of challenges because this is what, from experience I've been able to identify as an area of challenge. I don't think there's any area in accounting that is actually that simple, but of course over time, when you're practicing it or when you're using it, it becomes simple to you. And that is the reason why I identified the key areas of challenge so that we could be able to simplify them to the best of our abilities. Okay, so let's look at basic accounting today. And like I said, what we want to do is to start from the source documents to the final account. To the final account. Okay, so like I mentioned earlier, we are looking at source documents to final account. And first of all, what are the source documents we are talking about? Source documents are basically documents that we use in initiating or we use to evidence the initiation of a transaction. Of course, things like the receipt for transactions. Of course, receipt is for cash transactions. Things like invoice. Of course, where you basically we use them for credit transactions. Of course, and there are other source documents. You have your you could have your SMS bank alert, SMS bank alert. Of course, so many other forms of source documents. They are just, like I said, documents that evidence the initiation of the transaction. There are so many source documents. Your check or your bank deposit slip. That is if that still exists in some part of the world. Of course, the bank deposit slip, your POS slip, your POS receipt. The POS receipt. What else? There are so many source documents, that we definitely would talk about, but they are not limited to this. Now, when we look at source document, what is the next thing that should come to our mind or we should be thinking about? Now, the next thing for an accountant to think about is prime books of accounts. Prime books of account. Of course, prime books of accounts, we have other names like books of original entry. Of course, you can also call it subsidiary books, and they are basically saying the same thing. Now, in the prime books of accounts, we have some major books that we need to look at, but I'll just briefly talk about them because this course or this video is not expected to do the details here. There's always a video for you to get the 100% details, but I'll just briefly talk about this. And the prime books of accounts, we have the general journal, and the general journal, of course, is for all transactions. Of course, when I say all transactions, I'm talking about cash and credit transactions. We have the sales journal, or you could call it the sales day book, and this is basically for credit sales itself. We have the purchase journal, and the purchase journal is also credit transaction. We have the return inwards journal, which kind of affects the sales journal. We also have the return outward journal, which also affects the purchase journal. Then we have the cash book, and the cash book is for basically cash transactions. And we have the petty cash book. Again, the petty cash book is also cash transactions. So these are the prime books of accounts that we have, and these prime books of accounts, fuels the ledgers accounts, and from the ledgers accounts we have the what do you call it? From the ledgers accounts we have the trial balance. Let me use that word. And from the trial balance we have the profit or loss. From the profit or loss we have the balance sheet or the statement of financial position. From there we have the cash flow statements. Of course, that's basically the final accounts. But we have the double entry principles coming in. Now, the double entry principles, of course, I've said that for every debit entry, there must be a corresponding credit entry. So for every debit, there is a corresponding credit entry. Of course, for every debit, there's a corresponding credit entry, and for every credit, there's a corresponding debit entry. Now, this is where the challenge is. A lot of people don't really understand what we mean by double entry principle. So let me just show you something here. Here is a T account, and the T account has the debit side and the credit side, the debit side and the credit side. Now, for the T account, if you're going to debit something in this account, then the corresponding entry must be crediting another account. Of course, and if it is debit in this account, then it might also be credit in this account, as the case may be. So this actually is what we mean that for every debit entry, there must be a corresponding credit entry. It's not a fact of what accounts are we talking about, what should we be looking out for, and so on and so forth. Now, of course, there are so many rules to it. A lot of people have said we should debit the receiver and credit the giver. That's what some people have said: debit the receiving account and credit the giving account. This is actually a principle on its own that could help you. Another one also is, some people, or for me, what I usually let people to understand is that try as much as possible to know the nature of each transactions. Now, assets will always be a debit item. Expenses will also always be what? A debit item. But income will always be a credit item. Liability will always be a credit item. And equity also will always be a credit item. So it's not a factor of which one are you taking into consideration at every particular point in time. If the transaction relates to an asset, then when you have debit and you are debiting, of course, it means you are increasing the account. That's the implication. But when you have debit but you are crediting it, then it means you are reducing the account. On the other hand, where you have credit and you are also crediting, then you are also increasing the account. And where you have credits but you are debiting it, then it means you are decreasing the account or reducing the account. So this actually guides you for you to have an idea of when to debit and when to what? Credit. For example, if we talk about sales, sales in itself, of course, it's a credited transaction because it's an income item, but the corresponding entry, which is for you to sell, you must have received cash. Cash is an asset, therefore you're debiting cash. For you to sell on credit, then you have receivables. Receivables is an asset, therefore you are debiting receivables. Similarly, when you have expenses like administrative expense, of course, expense is a debit item, but for you to incur that expense, you must have parted away with what? Cash. Now, parting away with cash, you are supposed to credit what? Cash. It means you are reducing assets since you are crediting what? Cash. And if you are not parting away with cash, then liability comes to light because you are still crediting what? Liability. So the corresponding entry, the credit, you need to know what it is. Then you know whether it is affecting the assets or it is affecting the debit side or is affecting the credit side, as this will guide you a little bit. Okay, so we are going to quickly pick up, draw out some informations, and we use that informations to build, to do some necessary ledgers. From there, we'll build a trial balance and we move forward. So let's take some illustration on that. So first of all, let me say introduce capital at the beginning. At the beginning, let's say 2,000 cash and 4,000 and 4,000 bank. Then we have, that's one, we have paid or purchased goods on credit worth 3,000. We also have purchase goods with cash of with cash of 2,000 and bank of 15. Sold goods worth 5,000 on credit, and we have sold goods with cash of 4,000 and bank 3,000. Then we have purchase PPE we have purchase PPE with check of 3,000, then incurred general expense with cash of 2,000. So we have informations I've created here, and we are going to use these informations to, like I said, open necessary ledgers and close this ledgers account. Then we are also going to prepare a trial balance with that, and going forward from there, the final account. So the first information we have here, we have introduced capital at the beginning, 200 cash and 4,000 bank. Capital in itself is an account, cash is an account, and bank is an account. The question is, capital in its nature is an equity item, and since capital is an equity item, therefore we are going to credit capital. Bank and cash, they are assets in nature, so we debit and we debit. Therefore, if we open the necessary ledgers account here, so we have capital account, we have cash account, and we have bank account. So capital, we have cash, and we have bank account. Capital, we say we are crediting, so we have cash and bank, and the figures there are 2,000 and 4,000 respectively. 2,000, 4,000. Here we have capital 2,000, corresponding entry. We also have capital 4,000, corresponding entry, debit side. The next one we have is purchase of goods on credit worth 3,000. In this account, we have purchase as an account and we have credit as an account. Purchase, if we look at it, purchase is more like an expense, therefore should have a debit balance. Credit, as its name, credit, therefore we have a credit balance. But of course, credit here, we are talking about creditors, which is still the same thing as payables. So we have two accounts and we have the entries for these two accounts. So again, we have purchase account and payable account. Payable. Purchase account we have here payable, and payable account we have here purchase, corresponding entry. I think it's 3,000 and 3,000. Okay, and that is that in respect to that transaction. While on the other hand, we have purchased goods with cash of 2,000 and bank of what? 1,500. Again, like I've always said, we need to identify. We have purchase account, we have cash, and we have bank. Now this we have debit here, but since we have debit here, what is happening in this case? If you look at the purchase itself, you are receiving something, which is the goods, and you are giving out cash. Like we have said, the principle of debit the receiver and credit the giver. So you are giving out cash and you are giving out what? Bank. Therefore, in this case, we are crediting and we are what? Crediting this account. In that light, we have purchase account already. All we need to now do is to bring in cash and bank. While here, we will be having purchase and we also have purchase. And the figures there we have it to be 2,015. So we have 2,015. Here we have 2,000 and 15. Okay, so we've done the corresponding entry. The next one we have sold goods worth 5,000 on credit. Again, we have sales and we have credit. Sales, we say, is a credit item. This credit here is debtors or receivable, therefore a debit item, an asset in this case. So we have two accounts to open again. We'll be having the sales account and we have the receivable account. The sales account, like we said, it's a credit entry. So I have receivable here, and the receivable account I have sales here. And the figure we have there is 5,000. So we have 5,000 here. And we also have 5,000 here, corresponding entry. Okay. We have sold goods with cash of 4,000 and bank of 3,000. Again, sales, cash, and what? Bank, 3,000 and 4,000. So we already have sales account, we already have cash and bank accounts. So we have here sales and sales. And that is, let me use my different color to highlight it properly. So again, this is a credit entry and this is affecting assets because as cash is receiving and bank is receiving, so again we are debiting and we are debiting here. In that light, 4,000 and 3,000, we have 4,000 4,000 4,000 and 3,000, and we have here cash 4,000, bank 3,000. Okay, next we have is purchase PPE with check of 3,000. PPE is an asset. The purchase of PPE is an asset. Money is going out with check, which is going to the bank. We have bank already, and we have PPE now. So we have bank 3,000 and corresponding entry. We have PPE purchase 3,000 as well. Okay, then the next we have, or the final, is what? Incurred general expense with cash. So again, expense is a debit item and it's reducing cash because cash is given out, and that is why it's a credit item here. 2,000. So again, we open a T account for general expense, gen expense, and we have here cash 2,000, and the corresponding entry we have it to be gen expense 2,000. Okay, so we've opened all the necessary journals. Now it's the time to close up the accounts. So let's close up these accounts. Here we have 6,000 and 6,000. Balance CD 6,000 and BD 6,000. Here we have 6,000, 6,000. The balance CD 2,000 and the BD 2,000. Here we have 7,000, 7,000, and this is giving us 4,005. 4,500 minus 7,000, that should be 2,005. Balance CD and BD 2,500. Okay, sum this one up. 3,000 plus 2,000, 5,000. 5,000 plus 1,500, 6,500. Balance CD 6,500 and BD 6,500. 3,000, 3,000. Balance CD 3,000 and the BD brought down 3,000. 5,000 plus this is 9,000. 9,000 plus 3,000 is 12,000. 12,000. CD 12,000. BD 12,000. Receivable accounts 5,000. 5,000. CD 5,000. BD 5,000. PP account 3,000. 3,000. CD 3,000 and BD 3,000. We have 2,000, 2,000, CD 2,000 and BD 2,000. So what you've seen here is we've opened all the necessary journal ledgers and we've closed all the necessary account as well. Now bear in mind that you see here it ends at the credit side. This ends on the debit side. Credit side, debit side, debit side, credit side, credit side, and this ends on the debit side, and debit side. Now what I'm trying to show us is that if you look at this, it's an equity account, and of course the balance should be on the credit side. If you find it on the debit side, then there must be something wrong somewhere. Cash account, of course, it could be an overdraft where you sit on the other side, so it's possible to be on the credit side, but in this case it's an asset account because it's on the debit side. Purchase, of course, expense must always carry a debit balance, and that's why we have it there. Payables is a liability, have it on the credit side, that's why it's there. Sales is an a credit item, income. That's why it's on the credit side as well. Receivable is an asset account. That's why it has a debit balance. PPE is an asset account. That's why it has a debit balance. General expense is an expense account. That is why it also has a debit balance. In that light, we can now use this information to prepare a trial balance. So we have a trial balance. Trial balance, of course, as at the year end. We have the debit side and the credit side. We have the details here. So pick it one after the other and populate them in our trial balance. So the first we have is capital. Capital. Our capital was on the credit side, which is 6,000. Then we have cash. Because cash on the debit side, which was 2,000. We have bank as well. Bank was on the debit side, which was 2,005. Of course, those figures I could remember then, 6,000, 2,000, 2,005. Purchase is 6,500. So we have purchase 6,005. Then payables came next. And what do we have for payables? Payables is 3,000. 3,000. Then we have sales. And sales was 12,000. Then we have receivable. Of course, receivable 5,000. 5,000. PPE 3,000. General expense 2,000. Okay, sorry, my sales figure should come here, 12,000. That's an oversight. Okay, so with this information we have, we could do the summation. This is 9,000 already. 9,000 plus 12,000. That should give us 21,000. Let's confirm accuracy. Of course, this will also be 9,000. This will be 11,000. This is 16,000 here. This is 19,000 plus 21 and plus 2,000. That's still 21,000. So you could see the trial balance as balanced off because we were able to prepare the necessary ledgers and close the account accurately. Of course, we have errors that affect the trial balance, like what I've just almost done, moving this cash to debit side. It will affect the trial balance. We also have errors that do not affect the trial balance, which would have occurred from the ledgers section, but we're able to correctly account for all the transactions. Okay, so given this information, like I said, we could actually prepare a profit or loss. And the first thing we have, of course, let me use the word sales, since the sales I've been using, and that's 12,000. Because the next thing will be the cost of sales. But for the only information on cost of sales that we have in this scenario is purchase, and the purchase is 6,005. 6,500. Of course, this will give me a gross profit of 5,500. Then we have gen expense, and gen expense is 2,000. Of course, I ignored depreciation and all that. I'm just working with just the trial balance information, and this will give me profit for the year. Of course, where no other thing affects profit for the year to be 3,500. And that's that for the profit or loss. The statement of financial position, we have the assets, we have the non-current assets, and we have PPE, because without any depreciation, remains 3,000. Then we have the current assets, and we have receivable and receivable figure. And the trial balance is 5,000. 5,000. Then we have our cash and bank. Cash is 2,000. Bank is 2,005. Of course, this will give us total assets. Total assets. So we sum that up later. For the equity and liability section, we have equity, and equity we have capital, which is more like the share capital, 6,000. Then we have the profits, which is the retained earnings, and that is 3,005. And we have a current liability item here, which is payable. And what is the payable again? Figure. Payable is 3,000. 3,000. Okay, so we can do the summation. This is 9,500. 9,500 plus this will give us 12,500. So let's confirm accuracy here. This plus this is 8,000. 8,000 plus 12 plus 4,500 is 12,500. So, okay, so that's the trial balance. And like I said, we could also do the cash flow if we choose to do the cash flow, but it's not really big of a deal to do it. Let's just show it. Doesn't really matter. So the cash flow statement, of course, using the indirect method, we have the operating activities. And pardon me for the abbreviation, but you should have an idea of this. Operating activities is one of those activities. We have our profit for the year. Profit for the year, of course, which is 3,005. Then, of course, there's nothing to add back except for our changes in working capital, since we didn't have depreciation and all sorts. And changes in working capital, we don't have inventory. What we have is receivable. Now, receivable will come as a credit, as a negative figure here, because we have our customers owing us 5,000. So we have 5,000 negative. And we also have payable as a positive figure also. And the payable, we have it to be 3,000, a positive figure, 3,000. There are no other information that affects operating activities, so we can have this summation here. And this is 6,500 plus 6,500 minus 5,000 should give us 1,500, which is cash flow generated from operating activities. So you have to mention that. Then we have investing activities. Okay, we can abbreviate this one. And we have PPE. Of course, we invested in PPE, and PPE is 3,000 there. So we have a 3,000 negative. No other information. So cash flow used in investing activities, which is still the negative 3,000. Then we have financing activities as well. Financing activities, and financing activities, we have it to be capital, and the capital is 6,000. Okay, that's the only thing we have there. And we have it cash flow generated from financing activities 6,000. Net cash flow, because net cash flow will be the summation of operating activities, financing, investing activities, and financing activities. So we have 1,500 plus 6,000, that's 7,500. 7,500 minus 3,000, that will give us 4,500. So we have 4,500. Cash and cash equivalent brought forward is actually new because we are starting the business today, and we have cash and cash equivalent carried down to be 4,500. Of course, this figure is the bank and cash we have, which is 2,500 plus 2,000, or 2,000 plus 2,500, and that's what gives us that figure, which is this figure we have here in our balance sheet or statement of financial position. So you could see, if I'm to come back again to the beginning, from this information we were able to get to the final account. So from the source documents, we're able to open the necessary ledger account that affects the business. Then after doing so, we open the trial balance, and after the trial balance, we did the profit or loss, we did the statement of financial position items, and we also looked at the cash flow statement, the impact on the cash flow statement, which we also did to the last information. So if you're able to understand your double entries, which is the first thing we just talked about, and those key issues that would affect your accounting treatment, then you will be able to get to the final account. Now that you're done watching the video, I'm sure it was insightful and it was educational. Make sure you subscribe on our YouTube channel and like our videos, and also share these videos with other friends who might likely have the same exam as you. And I'm sure we'll be seeing again in another session. This is Learning Accounting.